There's a fellow named Fraser Perring, I beg your pardon, who actually was a social worker in the Midlands in England and decided to become a short seller with a couple of his friends, a couple of lads. They got together and they started looking at certain stocks, and they were focused on Carillion before this all went south. And they focused specifically because they bought a company for twice its traded value, and they said, that's a little fishy. And so they were all ready to go once it started to go south.
That's right, and this story, this Steinhoff story, it's the gift that keeps giving. Like this company has just gone from bad to worse over the past few months. We've seen the banks, particularly here in the US, with huge exposure. I think latest figures, about $22 billion worth of exposure, $1 billion already written down in loans on this. So you're right, this British guy, he came out as the short seller in this. He had really panicked because what he saw was Steinhoff, they went out, they bought Mattress Firm, which they paid, I think, $64 a share for. That was double the trading price when they announced the deal. And he said, well, hold on, either the market is valuing this thing at nothing and they've got it right, or they're valuing it at sort of 100% of what it's worth times over. And he said, this just can't be right. So he started to go short. He put out this very detailed research note, and then obviously we've seen this company just collapse.
And in the meantime, you got big banks being like, it's cool, we'll loan you money, exactly. No worries, man, all good.
And day after day at the moment, they're all reporting losses. And none of them are saying it's specifically Steinhoff, but it's this unnamed non-US stock. And,
yeah.
But I think it's over $1 billion total now, right?
For the US banks?
Except for US banks, it's over $1 billion.
We haven't heard anything from Morgan Stanley today, but yet everyone else, potentially we have to look through the fine lines. But my other story for that was HSBC, which actually used some credit derivatives to reduce its lending exposure as early as 2015. They packaged those derivatives and they sold them off to pension funds and to hedge funds. And now those hedge funds could be taking some big losses.
So this is when credit derivatives work, actually, right? Because they had some exposure, they decided to hedge it.
This is when credit derivatives work for the bank. But as you say, the people they sold them on to, I suppose, are not going to be best pleased. Yeah, this is about them having exposure to Carillion, obviously another very, very troubled company, a sort of traditional outsourcing company in the UK, does everything from really like cleaning up bus stops, graffiti, to sort of hospital work, etc.
In that these are the two, we're going to be talking about the exposure of banks, Carillion exposure, the way we're talking about Steinhoff in the next quarter. I mean, that's what's so interesting about it, is the exposure for banks and the detriment, really.
Yeah, and it's not just banks, it's also the public sector has huge exposure to Carillion because nearly all of the contracts that a company like Carillion works on are sort of government outsourced contracts. So there's a lot of really messy issues that need to be unpicked here, and this will be as much a political story as it is a corporate story.